Hello, everybody. Uh, Welcome back to Price Action Concepts. This will be Module 2. Today we're going to be talking about forming bias with structural arrays and just overall market structure that we learned in the previous module. Right, so first up we have supply and demand. Right, the last up candle before a large sell-off becomes supply. Right, so we have a 2-hour supply here. Right, this is also technically a 2-hour supply here. 2-hour supply, 2-hour supply. The inverse of this would be the demand, so it would be the last down candle before a large up thrust. This would form a demand. Right, so we need a impulsive move. Next up, we have breaker candles. So when price ignores a previous valid supply or demand, the last respective candle from the zone forms a breaker that price can potentially bounce from. So here, this is a breaker, right? This would have been an old valid supply. This is a breaker as we get a bounce from price from here. Oh, actually here, before I run off from this. So the reason too that this is usually a better breaker, if price comes up and tests a supply, this is also a breaker candle here. But if price comes up and tests a supply zone and it gets tested over and over and over, usually that candle will not be a breaker. Right, the candle that broke through the previous supply would create a demand zone, and that's more often your actual, well, it'll be your demand. That'll be more of your entry. When price completely negates something like this, right? So see how this one gets a test, but it doesn't really become a breaker because we came up, tested it, swept the low. And then this candle here is more of our demand zone, right? We get more of a reaction out of these two. We have impulsive moves up from these, right? We finally get a candle closure above this, right? And price trades back into this. So all more frequently, if a supply is tested over and over and over, it's usually not a breaker candle then. Order blocks, similar to supply and demand, but they have a few different requirements to be valid. Near key HTF resistances and support, opposing candle closure or consecutive candle closures before a break in market structure. Not required, but for my preference, they grab liquidity from equal lows or highs or a previous support or resistance swing point, or they enter into another order block or HTF arrays like an older supply or demand zone as well. So like people will refer to these in all sorts of different ways, and I think the definition of order blocks can be a bit subjective, right? Because to me, supply and demand, for example, doesn't have to be at a how do you say it? An HCF like key resistance or support, right? I prefer for order blocks usually to grab liquidity. Supply and demand zones don't have to grab liquidity for me to use them sometimes. I use them in continuations and other things like that. Fair value gaps. When price moves away from an area too quickly where previous candle wicks do not cover the candle's body, this creates an imbalance that price can return to later to fill. These do not always have to fill, but they can act as a magnet on price and other things like that. So usually when there is a large displacement in price, right, price moves away too often. So very quickly, I'm going to talk about why these work. My cat's stuck in the desk. So in order flow, I'm going to talk about this later on as well. In order flow, there are single prints. So these are liquidity imbalances. Fair value gaps aren't fair value because people want they need to retest the level. It's because if people are twap selling or something like that, it is just best to sell when price is going up, right? Not when price is going down. So price usually returns back to these single prints, especially if there's a point of control confluent with the area. So if it moves through a high liquidity area with no like a high liquidity cluster with no proper volume transacted in it, it will create a sell tail or a buy tail that price will eventually come back to finish the auction in. I'll also talk about auction market theory in some in another module, but this is just to lightly explain about how these things work. So here's some indicators for you guys. It's the break a structure / change a character by Nephew Sam. Key levels by Spaceman BTC, and the fair value gap by Anch. Or Anche, I don't know how to say his name. I know he's from Puerto Rico, I believe. So Spaceman BTC will show key levels throughout the chart that can be used for targets or provide context for movements to add confluence to ideas like session highs or daily lows or other significant pools of liquidity. So these will show the Monday ranges, which is one of my most favorite plays throughout the week, especially around if they're not touched by like Wednesday. If whatever side usually gets took, the inverse of that side gets taken as well. So if they take the lows, they usually go for the highs afterwards, or something equivalent to that, right? Fair value gap by Anch or Anche, I'm not sure how to pronounce his name, but these shows fair value gaps with their equilibriums. I will also talk about equilibriums when I talk about fibs, which should be in the next module. We'll get into some entry models and other things like that. Equilibriums are ICT's theory on how he uses fibs. Not my thing at all. Full credit to him on that. However, we will also be talking about the optimal trade entry, and that I'm pretty sure he said is not his with the with some of the fib settings that he uses. So break a structure / change of character by Nephew Sam. This will show order blocks, breaker blocks, change of character, and break of structure. This indicator is not perfect. However, I do think it may be helpful to people who are not accustomed to identifying these things. So this is not perfect at all by any means. But on the 15-minute, I do think it can be very good if you turn on the higher highs and higher lows setting, and it will show some of the pivot points or swing points that you guys can use to build a better track record of identifying them, right? Because they definitely can be a bit subjective sometimes, right? They're contextual, like I've said before. It's what you really see in price, and it's not something that I can initially teach. It's something you have to look at over and over and over and over and over, and just get accustomed to looking to. So I'd like to thank everybody for stopping by and watching this. Remember to like and subscribe, and happy trading, everybody.